This is a presentation on understanding some of the implications for Social Security as it relates to spousal benefits and survivor benefits. This is a continuation of the basic Social Security presentation, which explained individual Social Security benefits. Additional benefits available to couples may be significant. Consequently, planning as a couple is often quite a bit more complicated than planning as an individual. This presentation will attempt to explain and illustrate some of the more common spousal and survivor benefit strategies. The following is a required disclaimer. Let's look at Social Security spousal benefits. The creation of and the rules designed for Social Security spousal benefits were written in an earlier time, in 1939, when married women usually didn't work or made so little as to not earn a significant Social Security retirement benefit on their own. Depending on the ages of the primary breadwinner and a dependent spouse, the dependent spouse may be entitled to as much as 50% of the primary breadwinner's primary insurance amount, or his or her own earned benefit, whichever is higher. In terms of planning for combined Social Security benefits, the difficulty in deciding how to balance the need for current income as a couple against possible future survivor needs as a single can be complicated. Having different primary insurance amounts, PIAs, and different full retirement ages, FRAs, makes it even more so. It is often helpful to think in terms of joint income planning during your lifetimes, while also considering survivor income planning for the future. One popular strategy is to maximize the highest earner's benefit by delayed drawing until 70 to provide a higher lifetime benefit for the likely surviving spouse. When calculating spousal benefits, spouses may be able to receive the higher of their own benefit based on their earnings record, or up to 50% of the primary insurance amount of the working spouse. There are, however, some conditions and restrictions. First, they must be married for at least 1 year to be eligible to receive spousal benefits. Second, the worker must file for benefits before a spousal benefit is available. An important note is that a spousal benefit is based on when the spouse claims Social Security, not the worker. Also, spousal benefits are reduced for their own early filing, but not increased for delayed filing after their full retirement age. The earnings limit for early drawing applies to each individual filer separately. Here's an example to help illustrate this. Suppose a husband's benefit at a full retirement age of 66 is $2,400. The husband files early at age 62, so his benefit is reduced by 25% to $1,800. He is then subject to the earnings test. If the wife files for spousal benefits at her full retirement age based on her husband's earning record, the spousal benefit will be 50% of his PIA, that is 50% of $2,400, which is $1,200, not 50% of what the husband receives, meaning not 50% of $1,800, which is $900. She is also not subject to the earnings test since she is at her full retirement age. Savvy Social Security Analysis has a combined spousal benefits calculator that is useful in planning for future Social Security benefits. It requires your birth dates and your estimated primary insurance amounts as given by your most recent Social Security statements. You can manually input in various retirement dates and dates of death, and it will give monthly payouts at various breakpoints as well as a single cumulative lifetime payout total. You can also choose a death date and let the program use 4 commonly chosen retirement dates and see the effects. This scenario assumes Bob lives a normal lifespan, but Betty lives much longer than normal. So these are the assumptions. The scenario date we're using will be 2/1/2021, and the COLA will be 3%. The current ages for Bob is 65, born 12/1/1955, and Betty's 63, born 12/1/1957. Bob's primary insurance amount is $2,800, and Betty's is $1,500. Bob's life expectancy is 84, and Betty's is 96. Now remember, since they were both born before 1960, they will have slightly different full retirement ages. So, when should they claim Social Security? The charts on the next slide were created using a proprietary calculator to project total lifetime income based on ages and primary insurance amounts for 4 claiming strategies. You can input precise ages to test as well. In scenario 1, both Betty and Bob claim early and start benefits in February of 2021. Both have reduced benefits, although since Bob is older, his is not affected as much. Bob dies at 84 when Betty is 82. She continues with the survivor benefit for another 14 years until her death at 96. Lifetime benefits are $2,092,208. Now in scenario 2, both Betty and Bob claim at full retirement age. Thus, Bob starts his benefits in January of 2022 and Betty starts in May of 2024. Bob dies at 84 when Betty is 82. She continues with a survivor benefit for another 14 years until her death at 96. Now lifetime benefits are $2,209,140. In scenario 3, both Betty and Bob claim at age 70. Thus, Bob starts in December of 2025 and Betty starts in December of 2027. Bob dies at 84 when Betty is 82. She continues with the survivor benefit for another 14 years until her death at age 96. Total lifetime benefits are $2,609,856. In scenario 4, Betty claims early and Bob claims late. Betty starts benefits immediately in February of 2021, and Bob starts benefits in December of 2025 at age 70. Bob dies at 84 when Betty is 82. She continues with a survivor benefit for another 14 years until her death at 96. Total lifetime benefits, $2,559,432. Looking at the 4 scenarios leads to some interesting highlights. The difference between both starting early and both starting at their full retirement age is about a $107,000 difference over their lifetimes, where Betty lives to be 96 and Bob dies at 84. It is not a huge difference because both are already over the minimum starting age. Therefore, reductions are relatively modest. In the situation where Betty is claiming early with Bob claiming later, it's only slightly worse than both waiting to 70. There's a $40,000 difference. Betty gets to claim benefits a full 7 years earlier, but doesn't suffer later in her life since having Bob wait provided her with a large survivor benefit. As long as Bob waits until 70, the lifetime benefits for Betty living to age 96 is much higher. Betty's individual break-even point is near 80. Drawing early doesn't affect her greatly since she switches over to survivor benefits at age 82, which is near the time her early drawing would begin to penalize her. Be aware it is not always about maximizing lifetime benefits or even survivor benefits. We will address some important considerations a little later on. If you somehow knew the day you would die, Savvy Social Security analysis determines you could have maximized benefits if Bob had retired at age 70 and Betty retired at 69. This would give a lifetime benefit of $2,610,824. Not that you could necessarily predict this, but it gives an idea for comparison purposes. We now look at Savvy Social Security Analysis Part 2. This scenario assumes Bob lives a normal lifespan and Betty still lives much longer than normal. However, this time will make her primary insurance amount less than half of Bob's. This will likely mean Betty will get some add-on benefit based on Bob's Social Security. So the assumptions are mostly the same. Same scenario date, 2/1/2021, same cost of living, 3%. Bob's still 65, Betty's still 63. Bob's primary insurance amount is still $2,800, but Betty is only $1,000 instead of $1,500. Life expectancies, Bob is still living until 84 and Betty till 96. When should they claim Social Security? Charts on the next slide created using proprietary calculator to project total lifetime income based on age and primary insurance amounts for 4 common claiming strategies. You can input precise ages to test as well. Since Betty has some benefits of her own, she will get those with an additional spousal add-on benefit, but only when Bob claims his benefits. In scenario number 1, both Betty and Bob claim early and start benefits in February of 2021. Both have reduced benefits, although since Bob is older, his is not affected as much. Since Bob is getting benefits, Betty is entitled to add-on spousal benefit based on Bob's full PIA. But the benefit is reduced because she is taking it early. Bob dies at 84 when Betty is 82. She continues with only a survivor benefit for another 14 years until her death at 96. Lifetime benefits are $2,061,629. In scenario number 2, both Betty and Bob claim at full retirement age, with Bob starting benefits in January of 2022 and Betty in May of 2024. Since Bob is getting benefits, Betty is entitled to an add-on spousal benefit based on Bob's full primary insurance amount. Bob dies at 84 when Betty is 82. She continues with only a survivor benefit for another 14 years until her death at 96. Total lifetime benefits, $2,183,316. In scenario number 3, both Betty and Bob claim at age 70, and Bob starts benefits in December of 2025, and Betty starts in December of 2027. Since Bob is getting benefits, Betty is entitled to an add-on spousal benefit based on Bob's full primary insurance amount. Not his benefit at 70. Bob died at 84 when Betty's 82. She continues only with a survivor benefit for another 14 years until her death at 96. Total lifetime benefits are $2,499,115. In scenario number 4, Betty claims early, Bob claims late. Betty starts benefits in February of 2021, and Bob starts in December of 2025. Betty is entitled to an add-on spousal benefit when Bob claims benefits in December of 2025. Bob dies at 84 when Betty is 82. She continues with only a survivor benefit for another 14 years until her death at 96. Total lifetime benefits, $2,536,665. Looking at these 4 scenarios leads to some interesting highlights. The difference between both starting early and both starting at their full retirement ages is now about a $120,000 difference over the lifetime, where Betty lives to 96 and Bob dies at 84. It's not a huge difference because both are already over the starting minimum age. Her lower primary insurance amount is mostly offset by an additional spousal benefits since Bob is also retired. Her primary insurance amount is $500 a month less than it was before, but her total benefit is only $98 a month less than it was before. Betty claiming early with Bob claiming later is actually slightly better than both waiting to age 70. It's a $36,000 difference. Plus, Betty gets to claim a full 7 years earlier. Again, she doesn't suffer later in her life since Bob is having to wait provided her with a large survivor benefit. Plus, she did get some additional spousal benefits once Bob retired. As long as Bob waits until age 70, the lifetime benefits for Betty living to age 96 is much higher. For Betty, additional spousal benefits once Bob retires minimizes the damage to her early drawing. When survivor benefits kick in, the early drawing penalty is essentially eliminated. It is not always about maximizing lifetime benefits or survivor benefits. There are always other things to consider. Again, if you somehow knew the day you would die, savvy Social Security analysis determines they could maximize benefits if Bob retired at 70 and Betty retired at her full retirement age and drew add-on benefits at 68 in December of 2025 when Bob retired. This would give them a lifetime benefit of $2,559,677. When analyzing calculations, remember, everybody's situation is different. Simply maximizing your total lifetime payout is not always the objective. That is often impractical, since you do not know how long you will live. Your best plan may look at planning for the worst situation and seeing if you'll be able to live off your total retirement income streams. Your decision often depends on health concerns, lifestyle desires, income needs, and other financial considerations. Having the financial projections in front of you gives you an enhanced ability to make a more knowledgeable and hopefully better decision. There are some important things to consider if you're thinking about delayed drawing of Social Security. These projections don't take into account the time value of money. For the calculation of nominal benefits, $1 in benefits at 62 is counted the same as $1 at age 70. If you delay taking benefits for several years, where will the money to live off of come from? Will you continue to work, or will you draw down retirement accounts? Are you healthy enough to keep working? Do you want to keep working? If not, are you comfortable spending down retirement accounts in order to increase future Social Security benefits, knowing that if you die early, some or all of those benefits may be lost? There are some important things to consider if you are thinking about early drawing of Social Security. If you take your benefits early, will you be able to live comfortably? Will you have to downsize or move away from family or friends? Will you have to drastically change your lifestyle? Will you miss out on entertainment, travel, or activities? Will you be able to cover the possibly increasing healthcare costs? Will you be able to pay for possible long-term healthcare costs? For some couples, the biggest concern in terms of Social Security is survivor benefits. Survivor benefits are extremely important if one spouse has a much higher primary insurance amount than the other and is generally older. Survivor benefits are generally optimized to protect the lower or non-earning spouse. A spousal benefit maxes out at half the other spouse's primary insurance amount, where a survivor benefit maxes out at the highest benefit the other spouse receives. Thus, often it is better for the higher earning spouse, especially if older, to delay claiming Social Security to age 70 in order to get a higher benefit and to provide a higher survivor benefit if the higher earning spouse dies. In terms of survivor benefit, widows and widowers may receive benefits as early as age 60. This is different from retirement benefits. The earnings limit for early drawing still applies in this situation, however. The benefit amount is 71.5% of full benefit amount if taken at age 60 and is based on the deceased spouse's benefit. The reduction factor for survivors is different from the reduction for individual and spousal early retirement. You can choose to receive survivor benefits while letting your own benefit accrue delayed retirement credits up to age 70. You must have been married for at least 9 months in order to qualify for benefits. Survivor benefits are typically calculated based on the benefit the late spouse was receiving from Social Security at the time of death, or was entitled to receive based on age and earnings history if they had not yet claimed benefits. The following table gives a little bit more detail on the survivor's benefits. If the widow or widower has reached full retirement age, he or she is entitled to 100% survivor benefit. If you're at least 60 years old but haven't reached your full retirement age, you'll get either anywhere between 71.5% to 99% of the full survivor benefit. If you are any age and you're caring for a child who is under 16 or disabled, you are always entitled to at least 75% of the survivor benefit. Additionally, the qualifying child is also eligible for up to 75% of the survivor benefit. Now, a qualifying child is one who is younger than age 18 or between 18 and 19 but in elementary or secondary school as full-time students. Generally, a family maximum is calculated from a formula that is between 150 and 188% of the worker's basic Social Security benefit or primary insurance amount. Calculating survivor benefits, especially if taken early, is complicated. The Social Security Administration has a web calculator which gives the reduction for filing at various ages by month. Simply enter your date of birth using the website below. In conclusion, Social Security planning for couples is much more complicated than for individuals. Many of the benefits are favorable to non-working or lower wage earning spouses. However, there are numerous rules involving early or delayed drawing of spousal and survivor benefits. It is not always about maximizing total payout, but creating a livable income stream and protecting the lower wage earner or likely surviving spouse. Having the financial projections in front of you gives you an enhanced ability to make a more knowledgeable and hopefully better decision. Understanding and making the right decisions around taking Social Security as a couple can be a big driver of success in retirement. This presentation was given by Pegasus Financial Group. We suggest you work with your financial advisor to assess your personal situation. However, you may contact us for free Social Security calculation for your specific situation. Please email us at info@pegasusfg.com. Thank you.